Once bearish economists are now warning of a crash landing economic recession that could lead to 1 million immediate layoffs, and the reasons why might actually shock you guys. Meanwhile, Jamie Dimon liquidates $233 million worth of JP Morgan stock quietly in the shadows. But what does his move into cash really tell us about the current state of the market, and what can we do as consumers to prepare to find the deal of our dreams in the near future? And if that wasn't enough, we're also going to include the housing market, and we're going to include the fact that some economists are starting to flip on the housing market as well, and stating that there's turmoil heading for the 2025 housing market. Now, like the stock market, we're also going to ask the question is, what can we do as consumers to potentially find our dream home, find a deal of our dreams in the near future? So those are all the things we're going to go over today, you guys. Mitch Vexler, how are you, sir?
Good. It's been an interesting morning. I've been watching some of the reports come through on the state of Texas wanting to turn office inventory, excess inventory, into multifamily residential. It's pretty interesting, but we'll see how all this goes and how this plays out.
And one thing I forgot to mention to viewers about is Walmart stock tanking. Either way, Mitch, let's get into what these economists are saying about this hard landing. This article came out today, February 24th, titled, "Why the Apollo Economist Who Coined No Landing Now Sees Intensifying Risk to the U.S. Economy." While concerns about high valuations linger, and it's probably the biggest deal in that topic with real median household income, but we're not going to go over that. We're going to read this article. It was anxiety over the direction of the U.S. economy that seemed to feel the latest swoon. The yield on the 10-year Treasury dropped 8 basis points from the previous session after a services sector survey pointed to contraction and a gauge of consumer sentiment dipped. It appears some investors may be coming around to thinking of Ken Griffin, the billionaire founder of a hedge fund, who recently warned that the uncertainty and chaos created by, according to him, President Donald Trump and his tariffs are going to stunt growth. But he goes on and he says some really crazy stuff here. For now, some fears are intangible. More real are the swaths of government layoffs enacted by Elon Musk's so-called Department of Government Efficiency. But combine those two issues, and there is danger that downside risks to the U.S. economy are intensifying, according to Slock, Apollo chief economist, who was the first on Wall Street to coin the term "no landing" in reference to an economy that continued to grow at a healthy rate. But he's not talking about the freaking deficit or the inflation, because he's probably paid not to talk about it. In a note published over the weekend, Slock accepts that much U.S. economic data remains strong, except again, for this, I'm just going to pause real quick, real median household income. This is adjusted for inflation. We have not even hit 2019 peaks, so that is a very weak economic sign. Just to put this in perspective, and here's the crazy thing, guys, I didn't even go to school to become an economist. And I know this, that analysts' consensus expect 300,000 total DOGE-related job cuts. And as the chart below shows, there has already been a pickup in people filing for unemployment benefits in Washington, D.C. You guys can see that track up right there. It's a little bit hard to see that. But more importantly, listen to what this says. With total U.S. employment of 160 million, 7 million unemployed, and about 5 million people changing jobs every month, the 300,000 federal jobs lost is not statistically very much unless it's concentrated to local metro areas, and it will spread as it states. But studies show for every one federal employee, there are 2 contractor jobs lost. So the layoffs could be closer to 1 million. Any increase in layoffs will push jobless claims higher over the coming months, and such a rise in the unemployment rate is likely to have consequences for rates, equities, and credit. The next chart shows Slock suggests that while there has been increasing chatter about policy uncertainty, there are parts of the market that remain seemingly oblivious to the dangers. This is showing that IG spreads are disconnected from the economic policy uncertainty index, and the uncertainty index is in green. You guys can see that is absolutely skyrocketing. US IG corporate bond spreads is on the bottom. I'll read a little bit about this, but it's all going to equal credit tightening, which is good. But this is what this says. Credit spreads, the extra yield. So this is the profit. This is the fee in between, the excess, the fat, the extra yield that investors demand to lend to companies tend to move up during periods of economic policy uncertainty. But there is a clear disconnect at the moment with uncertainty spiking, but spreads hugging historical lows. Amazing they're not taking into account recession. This goes on to say that Morgan Stanley strategist Mike Wilson is also becoming more wary about U.S. economic growth and stickier interest rates amid tariff uncertainty, and reckons there are reasons why the S&P 500 has struggled to decisively break above the 6,100 level. Soft retail sales data from last month and tariff uncertainty suggest that a durable rebound in consumer discretionary goods relative performance remains elusive for now. Bottom line, continue to favor consumer services, says Wilson. I have a question on the chart that we looked at as far as spreads, Mitch. So the spreads and the uncertainty and basically businesses lending to businesses essentially means that the interest rates and the cost to do that is going to go up for those businesses. So that's kind of like credit tightening. Can you explain whether or not that is credit tightening and why credit tightening might be extremely important for the economy, being we're fighting inflation?
There's a lot to unpack in that memo. The first thing is that Ken Griffin is a very smart guy. He's smart enough to move his company out of Chicago, where the taxes are completely insane, into West Palm Beach, which means he's got economists, he's got people speaking to him. When they talk about the economists inside of that article, well, the economists have it all wrong. And as we've said, the only thing that matters is the median household income and the debt level. Well, that comes down to that Fred chart that Travis just showed you. The Fred chart literally isn't worth toilet paper. And the reason why it's not worth anything is because it does not include the debt load per household. And that goes to your question, Travis, what does this mean to the credit tightening? Well, the credit tightening is a ramification of the volatility, and volatility is created when stability becomes unstable. And volatility is actually something that is measurable, it's quantifiable, and that leads to the credit risk. So the more volatility spikes, the more credit risk there is, and the higher the interest rates, not the lower the interest rates, because people have to be compensated for the additional risk. Every one of these elements is hooked at the hip. And it all starts with a simple thing that the economists in general do not want to pay any attention to, and that's the median household income and the debt per household. Take that debt per household into account in that Fred report, then you get the truth, and that leads to what's coming with regard to the mass unemployment.
And Mitch, just for us, someone like me, a normal person, say I wanted to take advantage of an incoming recession, take advantage of an incoming stock market crash, what can I do right now, today, to prepare to take advantage of an incoming stock market crash in the near future? What should I do, in your opinion?
The first thing, surprisingly enough, is look around you at what you're doing. And if you've got money and you're not heavily indebted, look at who the third-party credit risk would be. If you're dealing with a bank that is, let's say, a regional bank, but that regional bank is heavily indebted with regard to real estate, commercial real estate in particular. Anybody that's doing subdivisions on a large scale have to be looked at. Well, that's third-party credit risk. And you could say, well, if I have more than $250,000, that's uninsured by the FDIC. Well, no, the FDIC is third-party credit risk. They don't have the money to cover off the collapse of 60 banks. It's not there. It's a false statement. So third-party credit risk, number one. Number two, go to cash and sit tight. So if you have, say, $500,000, you spread that out a couple banks in order to get the FDIC, even though it's completely useless, at least you're doing something. But it's the third-party credit risk in all of this that has to be taken into account. And then stay away from anything that's got debt, because if the government comes in and takes over a bank, well, that bank is now tainted. If you've got a mortgage with that bank, Your mortgage is now tainted, even though you may be fine. But the reality is your bank may not be. So this is the time to hunker down. If you've got the ability to go to cash, go to cash. There's some big players out there, and that's what they've been doing. And that's the right thing to do, because it is clear, irrefutably clear, that instability is on the rise. And by the way, Ken Griffin's comment that while this has to do with tariffs is complete nonsense.
Right, right. I meant to say that, yeah. But speaking of moving to cash, Mitch, let's take a look at what Jamie Dimon did in the shadows. So this just came out. JP Morgan Chase and Company recent SEC filings reveal that JP Morgan Chase CEO Jamie Dimon executed a significant stock transaction on February 20th, a few days ago. Dimon sold 783,000 shares of JP Morgan Chase for a total of a whopping, think of this as one man has this much money. It's just crazy. This is just some of his money, $233.8 million. Despite this sale, Dimon still retains substantial holdings in the company, including shares held directly through family trusts and other entities. Dimon has been with JP Morgan since 2004 and has served as CEO since 2006. Speculation about his potential resignation and retirement has risen, possibly explaining his substantial stock sale plans this year. Dimon has previously discussed succession plans publicly over the past few years. Mitch, it's interesting. They said the same thing about Warren Buffett and his moves to cash. How does Jamie Dimon's actions moving to cash mirror Warren Buffett's, and what can that tell us about what we should do?
Warren Buffett is much smarter than Jamie Dimon in that he is in the value business. He buys companies based on value. Jamie Dimon is the CEO of JP Morgan, which invests. So its leverage standpoint from an investment rate of return is much less as a bank than what Warren Buffett has ever done. So there are two different methods. Jamie Dimon's exposure, or JP Morgan's exposure per transaction, is infinitely much greater than what Warren Buffett ever did. So these are two different methods of looking at an investment, but they both have access to massive amounts of data. So Warren Buffett's method of looking at an investment on a value standpoint is much easier and cleaner. However, Jamie Dimon actually has access to all the data that can be stripped and mined to determine what's really going on. So he's just simply standing back, I'd be willing to bet, and saying, well, okay, I see problems coming because I see the books. So therefore, I will go and put a certain amount of cash off the table. I'm going to take it away, take my cookies off the table, and I'm going to go have a glass of milk. But these are the type of people that generally don't retire. They'll go to the grave trading. They'll go to the grave doing what it is that they do. And I'm very fond of that type of attitude. But you follow them as to what they're doing, and they're telling you and they're showing you the picture of exactly what's going on and why. You have to read between the lines, because when you listen to the economists, you're listening to the wrong people. The economists are delusional, and it's by intent. They speak based on who it is that's paying them. And that's not where you want to be. Look around you, look at the debt loads, and that tells you the truth. Jamie Dimon looked around him, looked at the debt loads, he got the truth, he got the memo. And that's why he's going to cash.
Speaking of delusional economists, let's see what some of those delusional economists are starting to say about the housing market. This article just came out from Newsweek titled, "Housing Market Gets Worrying Sign." Sales of existing homes in the U.S. fell by 4.9% in January compared to the month before, to a seasonally adjusted rate of 4.08 million, according to a new report by the National Association of Realtors, as high mortgage rates continue to discourage buyers. And that's really saying something, because last year and the year before, 2023 and 2024, were like historically, especially when we look at population, historically bad years. So the fact that this year has started out even worse, and yet inventory is skyrocketing as our price cuts, as our days on market, well, I think maybe some of these delusional economists are starting to wake up and realize median household income really does matter. Now, this is saying why it matters to them. A drop in sales across the US housing market suggests that the country is still in the midst of an affordability crisis. As mortgage rates are still hovering around the 7% mark, prices are still rising and inventory remains historically low. Despite this, dwindling sales could also indicate that sellers across the country may soon feel motivated to slash their asking prices in order to attract reluctant buyers. In fact, it's a record right now, according to Zillow, as far as those sellers slashing prices. What people are saying. So let's hear what a couple of these people are saying and let's analyze it. National Association of Realtors chief economist Lawrence Yun said in a statement accompanying the report, mortgage rates have refused to budge for several months. What about years? Despite multiple rounds of short-term interest rate cuts by the Federal Reserve. When combined with elevated home prices, housing affordability remains a major challenge. Great job, Lawrence. I can see why he's an economist. Daniel Hay, chief economist at Realtor.com, I'm sure these guys are going to know what's up, said in a statement shared with Newsweek, January's slower sales price was foreshadowed by a dip in pending home sales in December. Mortgage rates averaged 6.76% in November and December, when these homes with January closings generally went under contract. A noticeable uptick from September when mortgage rates were in the low 6% range. Despite the current affordability challenges faced by buyers in the U.S. housing market, Realtor.com expects sales to exceed 2024's long-term low in its 2025 housing forecast, as Americans may just accept that home ownership is now more expensive than it used to be. Well, we have to accept it because it's the math. And also, what are they basing that off of, being that we're starting the year out in a worse situation? Weaker rent growth matched against higher home buying costs have tilted the financial side of buy-rent decision towards renting in the US and the vast majority of large markets, because it makes more sense to rent than it does to own. But financial reasons are just one consideration for potential first-time home buyers. Many consider home ownership an important part of the American dream. All right, Mitch, so what happens in 2025 in regard to the housing market and why?
The answer is median household income, because that's all that matters. Who are your buyers? Right? Where are these buyers going to come from that can afford the price of the home? Let's put aside the debt load on the house as a direct result of the school districts. Let's put that to the side, which by the way is 50% roughly, but let's put it to the side. Where are the buyers going to come from? All these new subdivisions that are being created, all this new multifamily. So the average multifamily in an urban market at $325,000 a door to build requires roughly $3,200 a month in rent. Well, if the median household income did not keep pace with inflation, it's inverted. So what that means is all these people that are yipping and yapping are getting a piece of a shrinking pie. That's the problem. They're out there saying everything's great, come on, jump into the water. When in truth, the amount of buyers that are necessary to keep it afloat aren't there because they don't have the income. Then on top of that, when they don't have the income, not only do they not have the income, they're upside down another 50%. Right, due to the debt loads that are created by the central appraisal districts and the taxing entities. The combination is lethal. And that's what we've been pounding the table on. And that article is not a bad article. The problem is it doesn't go far enough. If we had a chance to sit down and speak with the person who wrote it, then we would explain exactly what we're saying in this video. You're missing the point. Median household income, look through that lens. And then you get clarity.
You know, Mitch, and this is for the viewers as well, as far as what I think is going to happen to the housing market in 2025. I think the housing market in 2025 is going to continue to show major cracks, but it's also going to continue to be bifurcated, meaning that some metro areas may not show the same amount of signs, say like Austin is being down 26% from peak, but I definitely think there's going to be a nationwide toxic housing market. I think the housing market is in 2026 is going to be worse, but this year I definitely think we're going to maintain active inventory at pre-pandemic levels. Some of the reasons I think that is because new listing growth is accelerating. The golden handcuff effect is being chiseled away at because there's more incentives for homeowners to sell, as renting is a lot more advantageous. That topped with recession, unaffordability, layoffs. I foresee the housing market is absolutely going to collapse collapse. Now, the important thing is, as consumers, understanding what a collapse means and understanding how the math works. In other words, understanding how to get a great deal. Now, before I give you the last words to end us out of here, Mitch, I wanted to point out is the Pentagon lays off 5,400 civilian workers, with tens of thousands more firings. And also, a lot of people are wondering what's going on with Walmart. Walmart's worst week since 2022. Not to mention that today, February 24th, Walmart stock lost nearly a whopping 10%. Those are just some of the headlines, guys. A lot going on. We had to pick and choose what to talk about today. Mitch, I'm going to give you the last words. Maybe you want to talk about the movement, the petition, the new course that you completed. But, sir, the last words are yours.
Do you remember when you were a kid, there used to be, you have a group of children, be 10 children and a whole bunch of chairs, and everybody's running around, and then they take one chair away so one child doesn't end up with a chair. That's really what's going on here. Everybody's busy, but are you going to be the one kid who doesn't get the chair? And they keep pulling chairs away. And that's really what's happening. The chairs are your money. So to that point, we have created several videos. So Dear Criminals was the most recent one, criminal complaint template, the bill and the letter to repeal the property tax. All of these things, including the video with Helen Kerwin in it, the most recent videos within the last month, including the video we produced as a direct result of sending the amicus brief to President Trump and Elon Musk. All these things are tied. And it comes right back to what we were discussing here today with the Economist. Pay attention to the median household income and the debt per household. Then you get the truth. Best not to be the child without a place where to sit.
Thank you for following along. Don't forget to like the video, share the video, comment on the video, and never forget to go to the Real Estate Mindset Empowerment Center at realestatemindset.org. It's also in the description. You can also get the link in this video, but either way, start empowering yourself. And know always, if you're out there investing in real estate or the stock market or yourself, we wish you luck and we hope you win.